Hello, this is Victor Colella, and I'm a financial planner here at Advisor Investments, and we're here with another Advisor You Can Talk To podcast. Today I'm joined by two colleagues of mine who I work with on a regular basis, both certified financial planners. Kari Wolfson is an account executive here at Advisor Investments, and Andrew Busa is a financial planner in our central planning group. Today, we're going to tell you everything you need to know about health savings accounts, or HSAs, within 10 minutes or less. Health savings accounts were created back in 2003 by our government as a way to react to rising healthcare costs, specifically for retirees. Andrew, you're going to give us the basics, but before you do, I just want to give you an idea of how big this problem is. Fidelity recently did a study that says a retiree today can expect to pay almost $300,000 across their retirement for healthcare costs. That's a big number. So Andrew, why don't you jump in and give us some of the basics?
Right, so HSAs are savings accounts that are very tax advantaged, specifically designed to be used for those healthcare expenses that you just mentioned. So what really makes an HSA special is that it's triple tax advantaged. So we want to emphasize this point. That means that contributions are tax deductible, growth inside the account is invested as well as tax-free, and distributions on the other end are tax-free if they're used for those qualified medical expenses. So that means, taken all together, this is the only tax-free investment that you can make today.
So basically, it's like a Roth IRA and a traditional IRA had a baby, so to speak. But there's a restriction. It's only that tax advantage if you use it for healthcare costs.
Exactly. So you can contribute $3,450 per year if you're an individual, and $6,900 per year for a family plan. And to be used for those qualified medical expenses that I mentioned earlier. So this could include things like dental, vision, long-term care premiums, Medicare premiums, COBRA premiums, the list goes on. So they're versatile. Typically, these plans are employer provided, but they don't need to be. And an important distinction here is that these are not flex spending accounts, or FSAs. FSAs have this use it or lose it component, meaning that they expire at the end of the year, whatever balance is in them. HSAs don't have that limitation. So whatever you contribute to the account rolls over from year to year, it rolls over from job to job. Overall, much better than FSAs.
Okay, so Kari, you work with clients on a regular basis. What's the typical client profile that you view as being a good fit for an HSA? So who do you have this conversation with?
Right. So if I think a client is a good fit, the first thing I'm going to do is understand their healthcare plan a little bit more. So they have to have a high deductible health plan. And to qualify for a high deductible health plan, the minimum deduction is $1,350 for individuals or $2,700 for families. You can't contribute once you're under another type of insurance plan, so no other coverage is allowed, or if you're currently under Medicare, you can't make contributions, but you can still use the HSA for those expenses. Income doesn't really matter, so there's no phase out, whether it's a lack or excess of income, and you need enough cash on hand to pay for your current medical prices, because remember, there's the higher deductible. Another thing we look at is whether or not they're a tax-sensitive client, because there's benefits of contributing to an HSA for tax purposes, and they need to be the right type of healthcare user.
So just to back up for a second, you said this high deductible health plan. Basically, the idea behind that rule is that the government isn't going to give you this sweet tax benefit if you're already covering 100% of your healthcare expenses through this generous plan through your spouse.
Exactly. So there has to be some out-of-pocket expenses.
And you mentioned if they're the right type of healthcare user. So we think about two major types here. So first, if you're someone who's healthy, pretty laid back about going to the doctor, you don't go to the doctor that frequently, this would probably be a good fit for you because you don't have to worry about hitting that high deductible for your healthcare to kick in. On the other hand, if you're someone who's unhealthy, you go to the doctor frequently, this probably wouldn't be a good fit for you if you don't have the cash on hand to meet all those out-of-pocket expenses, co-pays, etc. to hit your deductible.
Okay, I'm going to zoom back out. One of the reasons that HSAs were created in the first place, like I mentioned before, was to address the huge cost of healthcare, specifically in retirement. In order for that benefit to exist, though, the account has to be around in retirement. The reason I say this is there was a recent Towers-Watson study done that showed that a majority of HSA contributions over the last year actually left the accounts in the same year that they went into the accounts. Basically, they're using it like a flex spending account. They're spending it in the year that they put it in. Now, you do get a tax benefit. I'll give you an example. So if you spend the balance of your HSA the year that you put it in, you're basically getting a discount on your healthcare services equal to your marginal tax bracket. Let's say it's 30%. But if you let that account double or triple in the market and you continue to contribute to it as you're working so that it'll be there in retirement, that tax benefit is more like almost 50%, growing as the account grows. The reason being is that growth is never taxed. So we encourage our clients to actually use it like a savings vehicle, not a flex spending account, which you spend in the same year that you put the money in.
Right. So I had a client recently who just switched jobs and they were evaluating their new healthcare options. Their previous job, they had an FSA, a flex spending account, but they were always scared of over contributing because, as Andrew mentioned earlier, you have to use it or lose it each year. They were also healthy and not heavy healthcare users, so they weren't going to the doctor too frequently. They were very high earners, so they could afford to pay for their current healthcare costs from their savings, from their cash accounts, so they could pay for the higher out-of-pocket expenses. And also being the very high earners, they were more, they had tax-sensitive benefits that they could take advantage of with the HSA. So our recommendation was to establish the health savings account, maximize the contributions, and it could be invested for retirement for the long-term care expenses. And, the outcome, it's been going well so far. We think, they're going to have a great resource in retirement and the money is going to continue to grow and be a great benefit for them.
So let's say that I'm someone who's not yet retired. I'm actively saving towards retirement. And I'm trying to prioritize between my 401k account, my health savings account, let's say a Roth. How do you both think about the hierarchy of these accounts, where to direct your savings?
I'll take a first shot at this one. So just as a precursor, there really isn't one size fits all. But I can say a couple things with confidence. One, if you have a 401k employer match available to you, take advantage of it. And if you can, take advantage of it in full before you do anything else. That's free money, and if you have the ability to hit the match, it's a no-brainer. After you've taken advantage of that match, though, that's when I think the health savings account, the HSA, comes into the conversation, as well as the Roth account, if you're eligible for contributions. And there are a variety of factors that help prioritize between those two. But first, take advantage of the match, then take advantage of other tax-benefited vehicles like your HSA and your Roth. And then if you still have excess disposable income, then you can use it for maybe additional 401k contributions, maybe savings outside of your 401k or retirement plans in a brokerage account. Where you go from there very much depends on your situation.
Well, and remember, after 65, your health savings account turns into an IRA anyways, so you can take distributions for non-health care expenses, and it's just taxed as ordinary income. Before the age of 65, though, you have a big 20% penalty on any non-health care expenses that you're taking as distributions.
Yeah, and I really think that's a point of emphasis, right? You've built up this HSA over many, many years. You hit age 65, all of a sudden that 20% penalty, which is very steep, is wiped away, even if it's not used for qualified medical expenses. It's ordinary income at that point, but there's no penalty.
Right.
Okay, well, that's all we have for today. I'm going to give you a quick summary. So if you think that an HSA or a health savings account is a good fit for you, so you fit the profile that Kari talked about, first step would be talk to your employer, see if you have a high deductible health plan that's HSA eligible. And if you do, I think the next step is to open it up and begin contributing. But we work with our clients all the time on this. It's not always cut and dry. So if you have questions, we're absolutely here to help. This has been Kari Wolfson, Andrew Busa, and Victor Colella from Advisor Investments, and we're thanking you for listening to another Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe, review our show. You can also check us out at advisorinvestments.com/all-podcast. Your feedback truly is welcome. We want to hear from you. And if you have any topics you'd like for us to explore, we'd happily do a podcast just for you. So please send us an email at info@advisorinvestments.com if you have any suggestions. Thanks.